Today we are going to take our transactions and enter them into our transaction log. We are doing transactions for the company Boog Inc. Normally, we wouldn't use a transaction log. We would go right to recording journal entries. But I think this intermediate step is going to help to really understand what it is we're trying to achieve. So I have a list down here of 9 transactions plus an adjusting journal entry. And for each one, we are going to say which accounts we're increasing and which accounts we're decreasing. This transaction log follows our accounting equation. Assets equal liabilities plus equity. And remember, equity has our 4 layers, plus stock, minus dividends, plus revenue, minus expenses. Okay, so let's start with transaction number 1. Transaction number 1, Boog Inc. issues stock or ownership interest in exchange for $200,000. So we are Boog Inc., we received $200,000. And in exchange, we gave up ownership interest, stock. So our stock account will also increase. Okay, let's make sure that we've kept things equal. Our assets increased by $200,000 and our equity increased by $200,000. So we are in balance. Transaction number 2, Boog Inc. buys inventory for $5,000 on account. On account means that we're going to pay later. So let me enter transaction number 2. We received $5,000 of inventory, and instead of paying cash, we gave a promise to pay, which we call accounts payable. So on the asset side, we increased by $5,000. On the liability side, we increased by $5,000. So we're in balance. Transaction number 3, Boog Inc. buys equipment for $72,000 cash. The second part of it, don't worry about, we're going to use that later. So transaction number 3, we increase equipment by $72,000. And we paid cash, so we're going to decrease cash, $72,000. You see that the negative shows up as parentheses. In accounting, rather than using a minus sign, we use parentheses to indicate that it's a decrease or a negative number. So the net impact to our assets was 0. We increased equipment by $72,000 and decreased cash by $72,000. We didn't do anything on the liabilities or equity side, so that's 0 as well. So we're in balance. Transaction number 4, Boog Inc. sells consulting services on account for $50,000. That means we sold our services, but we're not going to receive the money until later. We call that an accounts receivable because we'll receive the cash later. So I'm going to enter $50,000 in accounts receivable. And when we sell something in the normal course of business, we call that revenue. Revenue increases equity, so an increase to revenue will be an increase to equity. We increased assets by $50,000 and we increased equity by $50,000, so we're in balance. Transaction 5, Boog Inc. sells consulting services on account for $70,000. This is going to be the exact same accounting as it was for transaction 4, just a different amount. So I'll enter $70,000 in accounts receivable and $70,000 in revenue. We increased revenue, which is an increase to equity. We increased assets by $70,000 and we increased equity by $70,000, so we're in balance. Transaction number 6, we are going to, Boog Inc., we're going to pay our employees $10,000. When we pay our employees, we call that an expense. So we have increased our expenses by $10,000. Expenses decrease equity. So an increase to expense is a decrease to equity. We also paid them in cash. Note that whenever we pay our employees, we always pay them in cash. Employees don't like a promise to pay later. So I'm going to decrease my cash by $10,000. Oops, and that should have a negative sign. Okay, so I decreased assets by $10,000 and I decreased equity by $10,000. So I'm in balance. Transaction 7, Boog Inc. is going to pay rent of $5,000. So we're going to decrease cash. Landlords, much like employees, do not like to be paid with a promise to pay. They want cash. So we're going to decrease cash $5,000. Rent is also an expense. So we've increased our expenses by $5,000. Expense is negative equity. So an increase to expenses is a decrease to equity. We've increased assets by $5,000 and we've decreased assets by $5,000 and we've decreased equity by $5,000. So we're in balance. Transaction number 8. I'm going to just scroll down here so you guys can see the rest of the transactions. Transaction number 8, we received $50,000 from the customer we billed in transaction number 4. So we received $50,000. So we're going to increase cash by $50,000 and we are going to decrease accounts receivable. Remember, accounts receivable was a promise to pay from the customer. They were going to pay us in the future. Now that they've paid us, there's no more promise to pay. And this should be a negative number. Just going to re-enter it. Okay, so we have a 0 net impact to assets. We increased cash and we decreased accounts receivable. We didn't impact liabilities or equity, so we have 0 on both sides and we're in balance. All right, so the next transaction is AJE number 1, where we record the depreciation expense on the equipment we purchased in transaction number 3. Depreciation expense is basically the way that we expense our assets, our fixed assets, which is what equipment is, over time. So when we buy the equipment, we put it in an asset account, and then as we use it up, we transfer that value to expense because the asset loses value over time. Okay, so depreciation expense has a formula. The formula is cost minus salvage value divided by useful life. And the salvage value is basically what we think it's worth when we will sell it, whatever it's done. This equipment has a 3-year useful life and a 0 salvage value. So we think we'll use this equipment for 3 years and then it will be worth 0 or nothing. Okay, so let's calculate our depreciation. So our depreciation is going to be cost, which is $72,000 minus salvage value of 0, divided by our useful life, which is 3 years, but we're doing our accounting monthly, so 3 years would also be 36 months. So if I take 72,000 divided by 36 months, that is going to equal depreciation of $2,000 a month. When we book our depreciation, that's going to be, well, let me put this here first, AJE 1. Depreciation is an expense, so we are going to increase our expenses by $2,000. Expenses are negative equity, so when we increase our expenses, we decrease equity. The offset to this is we are also going to decrease the value of the equipment in our books, but we're not going to impact the equipment account. We have a separate account where we track the decrease in value, and that's called accumulated depreciation. In our accumulated depreciation account, we are going to record the decrease in value. So we're going to record negative $2,000. So for AJE number 1, we've decreased our assets by $2,000, and we've decreased equity by $2,000, so we're in balance. Our final journal entry, number 9, we are going to pay a cash dividend equal to 10% of net income. Let's just fix that typo. Equal to 10% of net income. So before we know how much of a dividend we're going to pay, we have to calculate net income. So net income equals revenue minus expenses. So I'm going to add up all of my revenue. And it's $120,000. Then I'm going to add up all of my expenses. And we're going to try that one more time. And it's $17,000. So $120,000 minus $17,000 equals $103,000 net income. $103,000 net income times 10% or 0.10 equals a $10,300 dividend. We're going to pay this dividend in cash, so we are going to subtract $10,300 from our cash, and then we are going to record the dividend in our dividend account. And we've increased our dividends. Dividend reduces equity. So by increasing our dividends, we have decreased equity. We decreased our assets by $10,300, and we decreased our equity by $10,300, so we are in balance. We've now entered all of our transactions into the transaction log. The next step will be to create journal entries, which we'll do in the next video.